Hi everyone, this is Brian LaCroix. We're going to get started on our webinar in a couple of minutes. I just want to make sure that everyone can hear us. If you could raise your hand on the screen so we can know that everyone's there. Oh, I see a couple. Great. We'll get started in a couple of minutes. Thank you. All right. I think we're all set to get going. Welcome to our webinar today. We are going to talk about understanding indirect rates in SBIR funding vehicles. My name is Brian LaCroix. I'm one of the partners here at Jameson & Company. Ed Jameson was going to give the webinar today, but he unfortunately lost his voice last week coming back from the National SBIR conference down in Austin. So unfortunately he couldn't be with us today, but he asked if I'd take over, and we'll see if we can teach you a few things about understanding indirect rates. So a little bit about Jameson & Company. Well, first, before we get started on that, what we're going to do as far as questions go is I'm going to wait till the end of the webinar to answer questions. A lot of you have sent in some questions beforehand, and I'll address those first, and then from there we'll see if we can have any live questions with you guys. So if you can just, we'll hold off until the end so we can get started with that. So a little bit about Jameson & Company. Our firm was founded in 1978 by our managing partner's dad. He started the practice when he was let go from Honeywell. He was laid off with a lot of his engineering friends. A lot of his engineering friends at that time started their own business as well. So the firm was started handling tax work and also government contract work for all of those engineers coming out of Honeywell. As our managing partner bought out his dad, we decided at that point to center the practice solely on government contract and grant accounting. So at this point, about 99.9% of our client base are government contractors and grantees. That 0.1% is a client that I just like a lot, and we haven't had the heart to let him go yet. Our firm is made up of account managers and CPAs. All of us have 10+ years of experience. We have found over the years that in order to be successful with the government contract and grant accounting, you have to have a very strong, generally accepted accounting principle background, and you have to end up learning the government contract and granting as a learned trade. So we hire CPAs with a lot of experience, and then we teach them the government contract and grant accounting. At this point, we're in 27 states. We service all different agencies and all types of awards. And at this point, Jameson & Company has helped businesses across the country procure, manage, and survive audit on more than $4 billion in government contracts and grants. So a little bit about what we're going to do today. We are going to look at flexibly priced government contract funding vehicles, what that means, what you should be looking for to understand if you have one. We're going to take a look at your government funding strategy and why you should care about indirect rates. We'll talk about the multiplier and how the government views your indirect rates and whether you're competitive or not. We'll take a look at what the indirect rates are used for, whether you have a project or a business, and what your strategy is for that. And then we'll talk about the government's safe rates and why they're not really that safe at all for contractors and grantees. All right, so let's get started with FAR 52.216-7. This is known as the Allowable Cost and Payment Clause. This This clause basically means that you have a cost reimbursement grantor contract. Under a cost reimbursement grantor contract, you as the grantee or contractor are reimbursed for all of your allowable and reasonable direct and indirect costs. You'll know that you have a cost reimbursement contract. In your contract itself, there's a list of about 40, 50, 60 FAR clauses. If 52216-7 is in there, you will know that you have a cost reimbursement contract or grant. With the grantees, if you're doing business with the NIH or the Department of Energy, you have to look a little bit further. You would have to look in the individual policy and procedure manuals to understand what type of grant that you do have. And most grants these days come through as cost reimbursement for the most part. So let's talk about what kind of awards are cost reimbursement type awards. If you're doing business with the SBIR or STTR program and you have a phase 2 contract, most phase 2 contracts comes through as cost reimbursement. If you have an NIH grant or a DOE grant, phase 1 or phase 2, these come through as cost reimbursement as well. NSF grants are typically a little funny. They believe that the direct side of the projects are cost reimbursement and that the indirect sides are set amounts. If you have RPE contracts or if you have R01 grants, BAA contracts or barter awards, the majority of those awards will come through as cost reimbursement type contracts and grants. Again, if you have one of those awards, it means you get reimbursed for both your direct and indirect costs subject to the federal acquisition regulations. And the federal acquisition regulations determine whether those costs are allowable or unallowable. And on top, you'll notice if you have one of these cost reimbursement type awards, that's when you know that you need a Greek CPA, and we'll get to what we mean by that. So in general, CPAs tend to specialize in one of 3 areas. First, you have the tax accountants. Those folks specialize in the Internal Revenue Code. We like to say that these folks speak Spanish. And as far as the tax code goes and tax accountants, it doesn't pertain to much as far as government grants and contracts, where we like to say that the Spanish part is irrelevant to your grants and contracts. Then we have the CPAs who understand GAAP, which is generally accepted accounting principles. When you go through accounting school, you are taught generally accepted accounting principles. All CPAs are well versed in that, and all trained accountants are well versed in generally accepted accounting principles. We like to say that those people speak French, and we say that the GAAP part of the equation is very relevant. The backbone of the federal acquisition regulations is generally accepted accounting principles. What the government does is they take those principles and then they determine, based on that method of accounting, what they are going to pay and what they won't pay for. And then we have government accounting and audit specialists. We like to say that those folks speak Greek. And the reason for that is the federal acquisition regulations are a separate language all to themselves. They don't teach the FARs in school, so it is really a learned trade that folks who have been in the business for years have learned through dealing with the government contracts and grants, auditors, and so forth. So when prospects and clients come to us, we tend to hear a lot of the same questions over and over again when the folks are writing their proposals. And these are the general mistakes that we typically see. So when a prospect or a contractor comes up to us, a lot of times we hear that we were starting our own business and we're in a small business incubator, and we wanted to put as much money as possible into the scientific project, so we did not ask for a fee, overhead, or fringe benefits. So we get this all the time, that our prospects that are starting their business want to focus 100% on the project itself and put all of its resources into that. What we usually come back with is, well, how are you going to pay for things like rent and the lights and fringe benefits for the people that you're going to hire? Another question that we typically see is we have prospects come up to us, say, we intend to develop a commercial product and the strategy seemed to work well for getting our project's initial funding. Well, yes, you did get the initial funding, but overall, what was your strategy to get that product to market? We see a lot of times that folks will believe that one SBIR project will help get that product out to the commercial market. And while the intentions are good, for the most part we see that it takes more than that to get a product out to the market, that they really have to be developing a strategy to use not only government funding but other sources of funding as well in order to get their idea off the ground and into the commercial market. And then we have questions quite a bit saying, well, will these early mistakes affect future grants? Sometimes they will, sometimes they won't. We do see that decisions can affect future grants just for the fact that you may not be in business long enough if you don't have enough resources to pay for the indirect side of the equation. So it comes down to your overall strategy and how you're going to use government funding to develop your business. Most of our clients will come to us and they usually go one of two ways. Either they're going to bootstrap their company, and what bootstrapping their company means is they're going to use 100% of government funds to try to develop their technology until they reach a point where their valuation is high enough that they want to go out and raise capital, or it's enough to develop the technology to a point where they can commercialize a product. Then we have other folks that will use venture capital right away, in which case they're diluting themselves at an earlier stage, and at that point they are able to use the government funding to really focus on the scientific part of the equation, in which case the indirect rates don't mean as much as if you're bootstrapping it. So our clients take one of two approaches. Either they're going to raise capital right away and dilute themselves at a very early stage, or they're going to bootstrap their companies for the long term until their technology is at a more advanced stage where they can raise their value before they dilute their stock interest. So what do you use indirect money for? Indirect rates give you the money to build your business infrastructure with people, facilities, and processes, and allow you to work on the business instead of in the business. And we'll get to what that means. So first we're going to play a little bit of a game called direct, indirect, or unallowable. So we get these questions all the time, whether an expense is direct, should be directly charged to a project, or if they should be indirectly charged to the project, or if the government's going to pay for them at all. So in general, what a direct cost is a cost that can be specifically bought or purchased directly for a revenue-producing project, which would either be a grant, a contract, or a commercial revenue item. An indirect cost is an expense that benefits all of the company's projects. And of course, an unallowable cost is a cost that's either unallowable according to the federal acquisition regulations, or if you're doing business with an individual agency, the individual agency might take those federal acquisition regulations and put their own spin on it. For instance, NIH, they do not believe that patent costs are required by their grants. So they will not pay for patent costs. They will also not pay for research and development costs where a DoD contractor will. So you have to really be cognizant of the fact that each individual agency has its own twists on the main set of rules, which are the federal acquisition regulations. So some of the most typical items that we see in the whole game of direct, indirect, or unallowable, we have the first one, which is expenses not in the original cost proposal. So a lot of folks come up with us and say, you know, my research and development has taken certain twists and turns And some costs that we had, or that we didn't think we were going to need, we now need in order to advance the scope of the work. So we get the question all the time is, do I need permission to make those changes? And of course, the answer depends on the agency you're dealing with. Department of Defense, typically you do not need permission unless in the contract it specifies that permission is required. If you're an NIH grantee, they typically allow that you can rebudget grants up to 25% of the total grant amount without asking permission, understanding that the research that you're doing changes and is a live animal, if you will. So they allow you to take 25% and move it from budget category to budget category outside of indirect costs. In order to rebudget out of direct and into direct on an NIH grant, you need to have a negotiated rate agreement. How about a lab jacket? Whether this should be direct or indirect or unallowable. You're probably thinking to yourself, it probably could go both ways, and that is true. In most cases, we have lab jackets that a scientist will wear around the lab, and of course they're working on a lot of revenue-producing jobs, grants, and contracts. So that jacket benefits all of the company's projects. But then again, an instance can change where we had this one client out in the Midwest. They were doing bovine research. So what the client came to us and said is, should I be charging this lab jacket direct or indirect? And they said every time that they do the research on this one particular contract with the bovines, the jackets get destroyed. So they have to go out and replenish those jackets every time that they do work on the project, in which case it would be a direct cost because it benefits that one sole project. So the rule of thumb is whether it benefits the company as a whole or if it benefits a certain project. Employee benefits. You're going to have to set up a benefit program for your employees in order to attract people to come and work for you. So you're probably going to set up things like a health insurance plan, maybe a 401k plan, or an incentive comp plan. All of those benefits are allowable under the Federal Acquisition Regulations. So they typically come under indirect costs because it benefits all of your employees, which in turn benefits all of the company's jobs that you're performing. Rent expense. What should rent expense be, a direct or an indirect cost? So the rent can't specifically be applied to a project, so it typically comes under the indirect category. Now, what if you're the landlord of your company? A lot of companies will have the business owner where they own the building and then they rent it back. They rent it back to the company. So they'll have two separate entities, but they are related. The government has certain rules that you have to follow as far as rent expense if you're the landlord of a particular business. There's a whole allowable rent calculation that you have to go through. At the end of the day, you really can't charge commercial rental fees if you are the landlord of the building. The government wants to only reimburse you for your actual costs. So there's a whole calculation that goes along with that. Accountants and lawyers. These are typically allowable depending, again, on what they're doing. If you have lawyers that are writing up contracts for a capital raise, that's typically unallowable. Accountants, if they are working on the day-to-day work of the business, it's typically allowable. But if they are helping the CFO raise capital, again, that would be unallowable. Raising VC money, like I said on the previous line, is typically an unallowable cost. The government does not want to pay for you to run around and raise money and to substantiate your corporate capital structure. H-1B visas. You need people to work in your company and to work on your projects. So an H-1B visa is a cost that is typically associated with bringing someone in from outside the country and to be able to hire them. The government is willing to pay for that because they want the best people to come in and work on their jobs as well. Patent costs. Again, this comes down to what agency you're dealing with and what rules you're following under. For instance, NIH, like I said on a previous screen, they don't believe that patents are a requirement under their grants, and they typically will not pay for patent costs. But they may pay for patent strategy costs and IP strategy. Now, patents, for instance, under the federal acquisition regulations, if you have FAR clauses that make it a requirement under your contract, the Department of Defense may pay for that as part of your indirect rates as long as you meet certain criteria. So indirect rates, we look at indirect rates as a balancing act that most 98.3% of our client base get wrong at the initially. So what that means is that our prospects, they tend not to understand why it's important to put in the proper indirect rates into their contracts and grants in their proposal. So what we are going to show is why it's important and how to get it right. So what most people do when they write a proposal, they tend to work backwards. Now what does that mean? So when we see a lot of cost proposals, folks tend to work backwards. They know that the cap for an award is, let's say, $1,500,000. So the first thing they do is they work backwards and they make sure that they put in the budget for their 7% fee, which is the standard fee amount for most SBIR contracts and grants. And then what they do is they look and see what kind of direct cost items they're going to need in order to push the technology forward. So what they might do is they might be working with a university, in which case they have subcontract costs, in this case $400,000. They want to use a couple of prominent consultants because it makes their proposal look better, so they'll set aside some parts of the budget for them. So they'll use prominent consultant 1 for $50,000, number 2 for another $50,000, and then of course they'll have material costs, and then they'll take a look at who they have on staff and who they want to hire and how much direct labor they'll need for that. The common mistake that we typically see is after filling in those items, the indirect costs and the fringe benefits become a plug. Now, what we're going to show on the following screens is why that can be a problem, instead of doing it the opposite way where you project out what your company's indirect rates are going to be and then you put in the direct costs after the plugging in the indirect side. So let's talk about the multiplier. So what the multiplier is for each dollar of direct labor that you charge to a grant or a contract, what does that cost the federal government? So in this instance, if you have direct labor of $1, like I said, and you have a company that has an overhead rate and a G&A rate of 25%, what's that going to cost the government at the end of the day? So you charge $1 of labor, you multiply it by the company's overhead rate of 100%, that comes to $2. Then you would have to multiply that $2 by the company's G&A rate of 25%, which adds on another 50 cents to that $2, and now you're at $2.50. Then when you apply your profit percentage of 7%, that's 18 cents that you add on to the $2.50, and what you come down to is $2.68. So for each dollar of labor that you charge to the contract, you are actually charging the government $2.68. So what the government is always looking at multipliers, and in the following screens we're going to show you what they look at with those multiplier amounts. So in our experience with established DoD, SBIR type government contractors, the way that the government looks at the multipliers is anything less than $2.40, the government looks at that as being inexpensive. If you have a multiplier of $2.40 to $2.70, you're considered in the very normal range. From $2.70 to $3, you're considered expensive but not prohibitive. And anything above $3, you are considered very expensive. Now, that doesn't mean that the government won't do business with you. It just means that they're going to look at it as an expensive purchase. So, for instance, we have a client in New York that has a cutting-edge technology. Their multiplier is $3.20. They are an expensive government contractor, but the government can't get their technology anywhere else. So they are willing to pay the $3.20 in order to obtain that technology. Then we have another client who is in the service industry doing trainings for under the Old Faith Initiative Act. And what those trainings were priced at was a multiplier that was actually lower than $2. If they went over $2, they started to get pushback from their customer. So it all depends on what you're doing and how much the government is looking to purchase that, and whether they, of course, can get they may look at it whether they can get a better price elsewhere. But in our experience, if you have a multiplier in these ranges, that you're typically in the norm. If you're from 2.4 to 3.0, you're in the normal to a little more expensive range. So how does NIH look at the multiplier? So NIH typically looks at their costs a little differently. They typically have clients that have a fringe benefit rate and an F&A rate. So with their multiplier, you would have direct labor of $1. You would multiply it by a fringe rate of 35%. So that multiplier comes out to $1.35. And then when you add $1.15 for the 85% F&A rate, you come to a multiplier of $2.50. The normal range that we see NIH rates run at is for a fringe rate we see anywhere from 28% to 42%, and we've negotiated tons of fringe rates right in that range. We see F&A rates ranging from 55 to 70%. Depending on where you are, that's really the normal range. And when I say where you are, if you're in Cambridge, Massachusetts, your F&A rate may run higher. It may run 90 and 95%. If you're in San Francisco, the same thing. Or if you have a place in upstate New York, you might be a little bit less. So depending on what part of the country you are, what your actual costs are, and how the ratio works will determine whether the rates are fair and reasonable. So what drives your indirect rates? For the most part, with the SBIR program, our clients are small businesses where people are going to drive the company's indirect rates. Now, what does that mean? So if you have folks that are going to be working on a project, and what that means is you receive an SBIR grant and you're going to simply work on the project itself. All you're going to do is the science. Your rates are going to look a lot different if you're trying to develop a business. If you're trying to develop a business, your attention isn't going to be 100% on the grant and contract. You're going to be working on that, but you're also going to be working on items that benefit the business as a whole. So what does that mean? So if you're building strategic alliances for the business, that is working on the business. It's an indirect activity. If you are diversifying the company's revenue stream, so you're making sure that you have different streams of revenue to help benefit the business, so you're not reliant on one customer or one piece of revenue. That's working on your business. Again, it's an indirect activity. If you're advancing the technology overall, that's working on your business. Again, an indirect activity. and then you work on the project itself, which is a direct activity. That most businesses that we see, they will run a utilization rate of 65 to 70%. Now, what does that mean? A utilization rate is a ratio of direct labor divided by productive labor, which is direct labor plus indirect labor. The reason why that's important is your employees are not going to be busy 100% of the time. You will have either hiccups in funding, or you'll have projects that end, and then there's downtime until the next project starts. There's downtime associated with every company. So what happens is, if you don't project that downtime into your company's indirect rates, one, it won't allow you enough slack in your funding to work on your business, and two, if you do have those hiccups in funding, you really have to look up and down your roster, because you won't be able to afford to keep every employee that you have. So building into your indirect rates enough downtime allows you to stop and start projects, and it allows people to have somewhere to charge their time when they're not 100% billable. So let's take a look at that budget that was filled with basically plugs for the fringe and for the fringe rate and the indirect rate. So when the particular person used this proposal and they used the indirect rate as a plug, their indirect rates came in at 16.7% and their fringe rates came in at 17.6%. So what that did to their multiplier is it brought it down to 1.37. Now, if you remember the chart as to what was normal and what was very inexpensive, this comes in at the very inexpensive category. So what happens if you make that mistake, and what will you be feeling as a company? So if you have indirect rates that are too low, normally it's going to create automatic cash flow problems and project losses proportional to the degree of the miss. Now, if you're bootstrapping your company, what do you think happens to your business then? You're going to have to try to go out and get immediate inflows of cash to pay for all of those cost overruns. And sometimes the technology is not far enough to raise that kind of capital. So you tend to borrow from, you know, your relatives and stuff like that, put things on credit card, and in the end you'd be putting your company in debt just to make ends meet. It's not a necessary thing if you're able to ask your customer or on the grants and the contracts for what your actual costs are going to be. So we like to show this screen and talk about which actually has less risk. On the left you have a proposal where the majority of the costs are direct, and then on the right you have one that has about a little over half direct, and then the rest is indirect expenses. So which has less risk? You would think that the one on the left does, but in actuality the way that the government does look at this is they want to pay you for your normal and actual costs. Many times during these cost proposal reviews, they will put the reviews through what's called a financial capability audit. And if they look at a proposal where you're not asking enough for indirect costs, they're going to look at the proposal and say, are you going to be solvent in the 2 years that it takes to complete the project? Now, they will look in those instances and make sure that you have enough cash in the bank, or you've raised enough capital to pay for the inevitable cost overrun. So let's talk a little bit about safe rates. So if you're doing business with NSF or NIH through the SBIR program, they offer what's called a safe rate. So with NIH, it's 40% of all direct costs, and in NSF's case, it's 50% of direct labor. If you choose those safe rates, you do not have to negotiate an indirect rate with the government. and you won't have those rates being audited on an annual basis. That's attractive to a lot of businesses who likes to be audited, but what it comes down to, in most cases, these rates are not enough to pay for all of your expenses. Again, you would have to have other sources of financing in order to pay for the inevitable cost overruns that are going to come along with it. The 40% rate at NIH is, of course, it's not in all cases that it's not enough. Typically, if you have a lot of subcontractor costs on your NIH grant, it may be enough. But you really have to go through and project those indirect rates to understand if the 40% or the 50% of direct labor costs is enough for you to pay your bills. So we always put this screen up. So a lot of times we see NIH guys, and they will be committing what we like to call inadvertent fraud. So what does that mean? So we have a lot of folks, when they take that 40% indirect rate, if you haven't had an NIH grant in the past, the way that they pay people is they will put funds in what's called the payment management system. The Department of Defense, however, you have to submit a monthly invoice where you say, these are my direct costs, you apply your indirect rate to that, and that's the amount that you can bill. With the payment management system, however, you're able to go in and say, I have to pay my bills tomorrow. I need $30,000. You press a button and it's in your bank the next day. It's a fantastic system. We like to refer to it as dialing for dollars. Now, what happens though when you accept that 40% rate and you're not sure what your actual rates are running at, is you could be committing what's called inadvertent fraud. So you go down and you draw down your money, pay all of your bills, and at the end of the day, or you have to still have to measure your rates on your annual year. If your rates are running at greater than 40%, you've effectively overdrawn the government. So when you accept a 40% indirect rate, you basically say that I will not charge the government greater than 40. You can't rebudget your grant unless you receive a negotiated rate agreement letter. So what happens on a quarterly basis is you have to fill out the FFR reports that's submitted to the payment management system. Now, on that FFR report, what we see a lot of folks do inadvertently is they will put in that I earned 100% of what I drew down. Now, if you're running greater than 40% and you're drawing down at greater than 40%, you've actually overcharged the government. And of course, being a government form, it usually comes in with this line 13, that says, by signing this report, I certify that it is true, complete, and accurate to the best of my knowledge. I am aware that any false, fictitious, or fraudulent information may subject me to criminal, civil, or administrative penalties. Moving on. So we always so what happens if you make errors or you make these mistakes? The end result is you just don't want to be committing fraud. So I was actually I actually worked on this case. They brought me in as a specialist to help these guys out. But at the end of the day, we were able to get this case down to a misdemeanor, but the people still went to prison for it. And the reason was they were indicted by the federal government because they were rebudgeting grants, and the government took exception to it, and they basically faced up to a 5-year prison term as well as another 5 years upon each conviction of making false statements. Another case, we had a Washington State University, we were not part of this one, where the federal government took a look and they said that these people were overcharging their NSF, Department of Energy, and Department of Transportation grants, and of course they took exception to the overcharges. So it's important to get this stuff right so that way you don't get yourself into trouble in the long term. The federal government is a great way to get the initial funding that you need to get your technology off the ground. It all, of course, comes with strings attached, and you just have to understand those strings to make sure you stay out of trouble. So in summary, 98.3% propose indirect rates that are too low and baking cash flow problems and financial statement losses. It's important for you folks to understand and project your indirect rates to make sure you're putting in the proper amounts in your proposal, so that way the government is willing to pay for your reasonable and allowable indirect costs. You just have to make sure that you're asking for what you need. If you don't get this right, when your project turns into a business, it can be game ending, because if you're insolvent at the end, when all of a sudden your business is taking off and you don't have that availability to raise that kind of capital, you could be in trouble there. If it's done properly, cost reimbursement type work can be used to build your business. So how do we typically work with folks? We do indirect cost rate development with all of our clients. We look at we participate in financial negotiations with government officials. We do accounting system setups and trainings and periodic oversight. We prepare, of course, the annual incurred cost submission. That's the report that's submitted to the government when you need a negotiated indirect rate. And of course, we represent our clients during government audits of that indirect rate submission. So when might you want to call Jameson and Company? If you are filling out the cost portion of the proposal, you get to the indirect rate category and you're not quite sure what to put in there, might be a good time. If you're not realizing your 7% fee on your grants or contracts, if you have cash flow problems, if you have unexpected debt or dilution events, if you're having problems getting paid by your government agency, you don't know what your actual overhead rate is. We ask that question all the time of folks, and that's kind of how we gauge if they understand what they're doing. We'll ask what your actual overhead rate is. Most government contractors and grantees, they'll know it if they're into the business. If you're concerned when you're signing your federal financial form, and if you have concerns about your existing financial team. So how we work with folks, we have some introductory products that we typically sell so we can get to know you, you can get to know us and see if it's a good fit. If you have a simple phase 1 grant or contract, you of course have to set up a proper accounting system. We set up a phase 1 survival kit where we will set up the accounting system so it's in compliance, and we'll give you training as to how to keep yourself out of trouble until you hit phase 2. We do indirect rate projections and cost proposal support. We sell that for $895, where we will help you develop your indirect rates so you know what to put in the box when you're filling out the cost proposal. And then if you're an established government contractor and you have some questions or you're not really sure you're doing everything 100% correct, we do what we call a risk and compliance analysis, where we take a look at the system and see if you have any kind of glaring holes that you should be concerned about. So that really ends the webinar part of the presentation. What I'm going to do now is I am going to go through some of the questions, all of the questions that were sent to us beforehand, and then we can open it up. We still have about 15 minutes and we'll be able to take some questions from there. So question number 1, we spent right at $750,000. Do we need an audit? In preparing for an audit, how best to stay in compliance when we are an ultra small company? Well, if you receive DOE grants or NIH grants and you spent $750,000 or above, you are required to have what's called a uniform guidance audit. Now, what a uniform guidance audit is a compliance audit where you have to go to an outside public accounting firm and you would hire them to come in and audit you for the 11 areas of compliance that you signed up for with these grants. Normally the compliance audits are due 9 months after your year end. So if you spend $750K, you will need one of these audits. And if you're an ultra small company, how do you stay in compliance? Unfortunately, the government treats everyone as if they're a Raytheon. So you're subject to the same rules. Like the larger companies are subject to what's called full CAS, not to get too technical, but you're subject to full CAS compliance where you have to submit a whole document about how your accounting system runs, and that document gets audited from time to time. If you're a small business, you're subject to modified CAS, which means you have to keep cost accounting records. Everyone has to keep timesheets. You have to do labor distributions and deal with indirect rates in order to be compliant. Unfortunately, there's no way around that if you receive cost reimbursement type work. Next question is, can you be awarded a grant without having an indirect cost rate? Well, as you can tell from the slides that we put in, the answer is yes, but you better have outside sources of funding in order to pay for the inevitable cost overruns that are going to happen. Because if you put in 0% for the indirect rates, then you won't be able to charge any indirect costs to the project. How is QuickBooks or similar accounting systems, especially cloud-based, being looked at by DCAA? Well, QuickBooks itself won't be a compliant accounting system. You really have to add certain features to QuickBooks in order to make it compliant. QuickBooks, of course, owns 96% of the market, and most small businesses use it. You are able to set up the system that if you use QuickBooks as a main GL package to have it pass DCA's accounting system review, but you have to do other things, really accentuate the package with either Excel spreadsheets to handle the full-blown job cost reports and also to handle labor distributions. It's definitely doable. We get QuickBooks passed all the time with our audits. Relevance of indirect costs when proposing a fixed price proposal. The indirect costs are still relevant even with a fixed price project. So when you submit a cost proposal for a fixed price, the government goes through and they vet the individual cost elements of that fixed price proposal. And the reason they do that is under the FARs, a 7 to 15% profit margin is considered fair and reasonable, even in a fixed price project. So what they do is they go through and make sure that you have actual costs that make up the bulk of the cost part of the proposal, so that way you're only making that 7 to 15% fee. So you still have to project your indirect rates, so that way you're putting in an amount that they can vet when they go through the award process. Can slightly different indirect rates be used for 2 grant awards from the same agency? Both rates are lower than our actual indirect rates. Yes, they can be used if you have multiple grants and you're using different rates. It just makes it very difficult to manage those projects so you're not losing money on one or the other. The way that a typical company will set up if they have multiple projects is they establish one indirect rate that they will use on all their projects. So that way you're measuring to the same dollar amount for each project. If you're measuring to one indirect rate for one project and measuring to another indirect rate, it's hard to manage your indirect costs to come in and not lose money in that situation. If an organization also has grants that are privately funded and have their own indirect rates allowed, do they have to be treated the same as government in the accounting system? Well, if you have commercial projects, privately held grants going on, and then you have government grants, you have to keep a compliant system where you are discerning between direct and indirect costs for each individual project. So you would have one project set up for the private foundation grant, you'd have one project set up for the government work, and another project set up for the commercial work. All of that encompasses your full accounting system. So if you're subject to the government accounting rules, you have to establish a job cost system that will discern between all of your revenue producing projects. Let's see. Calculating indirect rates with uncompensated overtime. So uncompensated overtime is a complex issue, and you have multiple ways to handle it. But basically, in general, so we don't make the webinar go for 2 more hours, is when you have salaried people who are working overtime and you distribute labor at standard hourly rates, it creates what's called uncompensated overtime. And that's the difference between what people actually get paid and what's been distributed as payroll expense on the general ledger at the standard hourly rate. So in general, there are different ways to handle that. One that's acceptable to the government. One, you could change from standard hourly rates to blending that hourly rate on a monthly basis when you distribute the labor. What that means is you would take the hours divided by the salary, and that would calculate your hourly rate on a monthly basis. So your hourly rate would change from month to month depending on how many hours the person worked. Another way is you let the uncompensated overtime accumulate in your general ledger as accrued payroll, and at the end of the year you have to make a decision whether to pay that out or to actually, you would credit back your overhead labor to reduce your company's indirect rate. So at the end of the day, the concept behind that is the government only wants to reimburse you for your true cost. So if you didn't pay the cost, you can't claim it. So, but there are a couple of different ways to handle it. How does extensive delays by DCA in performing incurred cost audits impact a company, and how extensive is the liability? So what happens is DCA got way behind as far as their incurred cost audits, and what happened was, one, it affects you because you're not able to bill your retainage to the contract until they close out those years. Another way that it affected small businesses is you have to keep those records until the audit is complete. So answering questions from a DCA auditor about what happened like 6 or 7 years ago can be difficult, especially if you lose staff and you all of a sudden don't have the history behind you. So fortunately, Congress has really pushed DCAA, and DCAA has been on the radar for Congress in the last couple of years. And I was just at an NDIA conference last week that we spoke at, and DCAA should be up to date. I believe they said by 2018 they should be 100% caught up. And one of the ways that they've been catching up is they've been categorizing companies as either low risk or high risk. High risk, they come out and do an incurred cost audit. Low risk, they basically accept the rates as you propose them, and then they move on. So it's helped a lot of smaller contractors. I can say from our client base, DCA has done a pretty good job in the last couple of years to catch up. I would say that we don't have anyone older than 2014 at this point. Who schedules the audit? Well, if you're an NIH grantee and you spent more than $750K, like I said on a previous question, you have to go out and hire that independent auditor to do your compliance audit. If you're negotiating a rate with NIH, you have to submit an annual incurred cost submission that the folks down at DFAS, Division of Financial Advisory Services, will audit on a yearly basis. If you're a Department of Defense contractor, you don't contact DCAA, they contact you. They will contact you when they're ready to come out and audit you. NIH allows rebudgeting of 25% without prior approval. In the case of a 3-tiered indirect cost base, how do you handle the indirect costs when rebudgeting from services that do not carry an overhead to salary, which does carry an overhead? You really have to go back and you have to take the total amount of money that's left on the whole grant And you basically, the way that I do it is I would redo the rest of the budget. So for instance, if I had a $500,000 grant, I've spent $200,000 of it, and now I have $300,000 left, I would take that $300,000 and rebudget it based on the dollars that I had left, and I would redo the rest of the proposal for that $300,000. So that way I'd be applying the indirect cost properly. Yes, you might come up with some extra expenses, but they allow you to rebudget as long as you have a negotiated rate agreement. They allow you to rebudget into categories, like you said, up to 25% without prior approval. So I would just rework the proposal to come up with the new 300K. So that handles all the questions that were sent in. Let's see if we can take a couple. We have about 10 minutes. We can take some live questions if we have some. If you have a live question, why don't you raise your hand and we'll see if we can unmute you and let you ask the question. Oh, there's a few. Okay, Joyce, are you there? All right, we'll try Judy. Are you there, and do you have a question?
You're Judy. No, I'm good.
Okay. Let's see. If anyone else has a question that you want us to call on you, you can raise your hand in the box and we'll go down the list. Oh, Bryce, are you there? Do you have a question that you want us to answer?
Yeah, can you hear me okay?
Yes, I can.
Okay, great, thank you. Just a question on the multiplier you talked about before, the DoD SBIR multiplier. So
Yep.
when you say, let's say 2.4, does that mean $2.40 in indirect costs for every $1 in direct costs, and thus you'd have equivalent of, for that, if you were to bucketize that, let's say that's like $3.40. Is that how I interpret that?
No, not totally. So what that means is for every dollar of direct labor that I charge, when you add on the indirect costs associated to that direct labor, for instance, if I have a 100% overhead rate and a 50% G&A rate, what does that equal to the government? So I charge $1 to a contract, I add in 100% overhead rate, that's another $1. So that now I'm at $2. Then I add in my 50% G&A rate, that's $1. So now I'm at $3. And let's skip the fee for now. So my multiplier would be $3 total. So my bill to the government would be $3 if I had that rate structure. Does that answer it?
Yes, thank you.
You're welcome. All right. Let's go down the list. How about Holly? Do you have a question?
Yes, I do. We've had several Phase 2 contracts. They've always been cost plus fixed fee. And we're about to get another one. And I have read that you could request a firm fixed price. Is there anything special to convince them to issue a Phase 2 firm fixed price?
You can definitely request it. At the end of the day, the contracting officer is the one that makes that decision. So what we find, they obviously have criteria that they have to go through in order to determine what type of contract that they're going to give you. What we find is with the research and development expenses, because they're level of effort contracts, what that means with the SBIR program, it's research and development. It doesn't always work. So at the end of the day, you might not be able to produce what you intended to set out for. Because of that, they like to have some oversight onto the money being spent. So they tend to make those cost reimbursement type contracts. You can definitely ask. In my experience, at the end of the day, the contracting officer already has a decision in his mind how he's going to make the contract. But I see that option all the time. I find it funny that they give you the option in some of the proposals.
Okay. All right. Thank you.
You're welcome. We try Judy. Oh. Joseph,
Yep.
do you have a question?
Yes, I do. Hi. Thanks for the webinar. So I have started off with some NASA grants that were transferred out of a nonprofit, and I'm contemplating applying for an SBIR, which is due January 20th next year. And do I need to apply the same indirect cost rates that I have now on my NASA grants to go forward? Is one question, and I also didn't have any profit in the current grants, but would certainly want to add that to an SBIR grant.
Yep. So normally with grants, especially ones that are coming out of a university, grants typically do not have profit margins on them. The SBIR, the SBIR program is an exception to that. So let's pretend you were applying for an NIH grant, an NSF grant, or even a Department of Energy grant.
It's NASA.
Yep, I get that. I'm just making the point that with those grants, you'd be able to apply the fixed fee to it. Now, with the NASA project and what you're going to project for indirects for the SBIR is you're supposed to look forward and say, okay, in the coming year, what are my indirect rates going to look like in the event that I win? So you would take a look and you would project out what your company's indirect costs are going to look like, what you're going to have for staff, what you're going to have for direct costs. And based on all of those factors, that will determine what you put into the cost proposal. So it's a forward-looking projection of what your indirect rates are going to look like. What the government does is they will look historically on those rates and say and make sure that that what you're asking for is reasonable. NSF's a different animal for NSF grantees out there. They will not accept rates unless that are greater than what you ran at for the prior year. They handle the indirect rates differently. Now, as far as like the fixed fee amount for that NASA SBIR, you should be able to apply the fee to it.
Okay. And if I do come up and project a different indirect cost rate on the SBIR proposal, how does that affect the still ongoing grants that I have already awarded under the current indirect cost rate?
So usually what happens is you obviously want to be using the same rate structure across all of your revenue producing projects. So you would probably go back to your original grants and say, listen, I had a rate change this year. I'd like to use my new rates for this grant. And depending on who the grants are with and stuff like that, you may get pushback. They may tell you no, or they may say that's perfectly reasonable. So a lot of it depends on your existing customer.
Okay, so it's a negotiation in some ways.
A little bit.
Yeah. Okay, thank you.
You're welcome. All right, we're going to move on. We're just going down our list. Natalie. Hi, Natalie. Do you have a question we can help with?
Hi, I do, yes. I have a consultancy that works with a number of small companies applying for SBIR grants from a variety of agencies, mostly NIH and some DOD. Some of these companies are, as you said, ultra small, and often the grant writing effort is kind of last minute. And so the question is, as a general rule, at what point does a company say, okay, we're going to stop, we're going to negotiate indirect cost rate and go forward, knowing that the chances of success are so small anyway?
The chances of success with the proposal itself, or?
Right, with the proposal itself, right.
So the process for getting a negotiated rate agreement is let's pretend it's an NIH proposal, right? You would project your indirect rates, and assuming that it comes in over 40%, you would put in what you're projecting, and what you would put there is to be negotiated upon award. Now, what I recommend typically is until you receive a favorable priority score, one, DFAS won't talk to you anyway unless they're ready to fund the thing, and two, that it's just not cost effective to pull together the 70-page proposal that you need to get the negotiated rate until the thing's going to be funded. So let's pretend you receive a favorable priority score. It looks like the thing's going to be funded. At that point, you would submit your indirect cost proposal to them. They would go through, and because they're SBIR, it's the SBIR program, and that they understand that these are small businesses, the DFAS is trained to really look at the proposal, just make sure you're not doing anything silly or asking for anything that's unreasonable, and then they talk to the grants management specialist and say, hey, listen, we received this cost proposal, the rates look reasonable, try not to put a restriction on the indirect rates until the rate gets negotiated. Because the grant management specialist, their first instinct is to restrict the indirect rates until they receive a negotiated rate agreement letter. Once you do receive a negotiated rate agreement letter, it becomes a lot easier to manage the indirect costs moving forward. It just gives you support for any proposal that you're putting in, and it allows the awarding agency to verify that the rates are good a lot more quickly.
And this can be can this be completed in reasonable time so you can get the award without long delays?
They won't delay the award. Like I said, the grants management specialist will try to restrict the indirect rates, in which case it's important that you're making sure the folks at DFAS are talking to the grants management specialist. I do it quite a bit because a lot of our SBIR folks, it's their first rate agreement letter, and DFAS has done a nice job setting aside a division of their auditors that deal just with the SBIR program, and Dan Milstead over there has really organized it so it moves pretty quickly. I've been very pleased with their efforts there.
Thank you.
You're welcome. We're just going down the list. It looks like we got everybody. So thank you all for coming. I hope you got something out of the webinar. We try to do these quite a bit. I'm sure Katie, our marketing director, will be sending out advertisement when our next one was, and we look forward to seeing you again. Take care.